Is joining us, and Luke, appreciate you joining us here. We were just taking a look here at the indices, the move lower that we're seeing off the recent highs, and I guess I'm starting to wonder if this is really just some of the enthusiasm that we were seeing related to a vaccine just kind of taking a back seat or being overshadowed somewhat by some of the lockdown measures and concerns that I was just mentioning at the top of the show here.
Yeah, hi Ben, thanks for having me on again. I think that's a lot of what it is. I think the market's trying to figure out what its narrative is, which is it was, hey, lockdown is good because it's going to mean more money from the government and from the Fed, and now it's, hey, we've got a vaccine, that's good, and now it's, hey, we have a vaccine, and rates are moving up really fast, and maybe we're not going to get more stimulus, and maybe that's not good, and now we're into now we're getting another round of lockdowns, so maybe that's bad, and I just think it's really trying to figure out what it wants to be when it grows up, so to speak.
It is tough to figure it out, and this is probably part of the ebb and flows we've been talking about here on the show, and the digestive nature in terms of some of the data. Here we're looking at rates relative to the ES in terms of what you were just talking about. They have and continue to remain at historic lows here. Something more to be concerned about here, or is it just that, in your opinion, Luke? Is it just digestive, or again, I mean, with the NASDAQ kind of stalling out, everybody's a little bit concerned about that. It had been the pillar of strength, I guess. Should we be more concerned?
I think in the near term, rates probably continue to grind. Let me back up. I think if the vaccine does what it's supposed to do and the lockdowns don't get carried away, I think we'll continue to see rates grind higher, and some of these duration proxies, such as the NASDAQ, such as gold, and even maybe Bitcoin, but will start to or continue to have these corrective trades. Ultimately, under that set of circumstances, though, I think it's important to keep in mind the bigger picture, which is we headed into the COVID crisis with the U.S. fiscal situation, really with an incipient U.S. fiscal crisis. The COVID crisis blew a gaping hole in the U.S. fiscal situation. And to me, to the extent rates continue to back up under a hope of a vaccine returning us to normal and velocity and growth picking back up, I think that trade of rates up, gold down, duration plays like NASDAQ down will only continue for as long as it takes for the 10-year to hit the level that the Fed's going to have to cap it. And I think that's ultimately where we sort of are right now, is sort of in between these two trapezes of the Fed's keeping us together, and we've let go of that trapeze, and now we're waiting to catch the one that is, okay, the 10-year is at a yield that is no longer politically expedient, which is to say it's at a level that will bankrupt the U.S. government. And so the Fed will have to explicitly come out and say, we're not going to let the 10-year trade over X. And I think the $64,000 question, presuming the vaccine pick does what it's supposed to do, and presuming this second wave doesn't get as bad as the first in terms of lockdowns, the $64,000 question is what's that level on the 10-year? And I don't have a great answer for that at this point, but I think that's the most important question in markets today.
All right, let's talk about what's anchoring some of those trapeze wires that we're navigating right now. As you just mentioned, I noticed that you took note of the, we have to fund all of this somehow, basically, and you took note of those results from the 20-year bond auction yesterday. You tweeted they were important. Why and how so?
So I think it is ultimately, there is a number of gauges when we talk about, when I say one of the most important numbers in markets is what's the level on the 10-year that causes a problem that forces the Fed to step in to explicitly cap it, which is where I think this movie is going in some way, shape, or form. And so I think there's a number of pressure gauges, if you will, that help determine that level. One of them, I think, is the equity market. One of them, I think, is how Treasury auctions go. And so as long as Treasury auctions, particularly the long end, are going well, then I think the Fed can continue to feel comfortable that they're doing enough. When you start getting some indigestion in these auctions, and I don't want to play 5-minute macro, make too much of one particular auction. But when in the past, when we started seeing these types of poor auctions, particularly at the longer end, then I think that starts to change the dynamic. It's all else equal in the near term dollar supportive. It tends to be gold negative. It tends to be equities negative. But I think it starts to flag. I think it's a signpost really of that we're getting nearer to the point where the Fed is pressed into either upsizing QE or explicitly implementing some sort of yield curve control from that point on.
Luke, a few minutes ago you mentioned the hole that had been blown in the fiscal situation. Let's talk a little bit about that as well. I mean, we're talking about 27, I think it is now, $1 trillion in debt, 3.2 yearly. I mean, where does that put the U.S. dollar, for one, ultimately? And then I guess tied to that question, is that what's supporting and driving the move higher in Bitcoin, do you think?
Yeah, so the fiscal situation is just, October's deficit was a perfect example. U.S. deficit in October, $284 billion. It was by far the biggest October deficit. Of course, you can't straight annualize it because there's puts and takes. There's seasonality throughout the year. But obviously that annualizes if we just straight lined it well above $3 trillion. And importantly within that number, and this is something I think people continue to underappreciate, is that if you look within that deficit, the things that look like interest expense. So the U.S.'s net interest expense, but then also its entitlement pay-as-you-goes. Those two numbers added up once again to more than 100% of U.S. tax receipts. And so once you are having to print the money to pay your effective interest, you are in a bad way.
Yeah.
So I think ultimately what it means for the dollar in the long run is the dollars needs to be trading several zip codes lower. Now, in the short run, because the dollar is such a big funding currency globally, if the Fed doesn't do enough, these dynamics paradoxically drive the dollar higher. But ultimately, again, because we're talking about the funding problem of the United States, the Fed's going to have to step in at some point in a bigger way. And the only question in our view is really when and how much. And in terms of how that plays out for Bitcoin, ultimately, I think we are seeing these dynamics play out probably in the cleanest manner in Bitcoin, because Bitcoin is such a young market. It looks like a digital gold. It has some supply dynamics that are superior to gold. And most importantly, in our view, it does not have the legacy baggage of the gigantic paper derivative markets attached to it that gold does, that ultimately muddy the water in terms of price discovery on a pure supply-demand basis. I think what we're seeing in Bitcoin's telling you in the cleanest manner of what's happening with this fiscal picture. And I think eventually gold is going to do much of the same thing. But like I said, for the time being, it's a little bit muddy of a picture given the derivatives attached to it.
Yeah, gold still holding up above 1850. We're going to talk about that later in terms of that being key support. I'll let you go here in just 1 minute, Luke, but I wanted to get one final thought from, because you were just talking about how the Fed, a matter of not so much when or a matter of how much they're going to do is the question here. That also seems to be the question in terms of stimulus measures from lawmakers. We heard a little bit about how McConnell might be willing to do something along the lines of, what was it, 500 million, well below, well below the 2.2 trillion I think that Democrats want, or well below, regardless of what the actual number is. But I mean, ultimately, do you see something coming through right now in terms of during this lame duck session, or are we going to have to wait till we get into 2021 to see something? And ultimately, is that potentially what's weighing on markets as well right now?
Yeah, I originally thought they would have had something done actually before the election, and I was totally wrong about that. And then I thought, well, they'd have something after the election, and I've been totally wrong about that. The one thing so at this point, I think it's very possible they don't get anything done until the new president is inaugurated. And if that's the case, that could be weighing on markets, and that puts more impetus on the Fed to do more than maybe they might otherwise do, or else we'll have the sort of risk-off profile that we were talking about earlier. The one thing that has grabbed my attention recently has been repeated mentions by the Biden administration or presumed Biden administration and campaign that they would use the Defense Production Act to fight COVID, which the Defense Production Act is remarkably obtuse in terms of what they can do to stimulate, and to address the COVID pandemic is also remarkably obtuse. And so that's one thing I would watch in terms of there seems to be a building expectation that nothing's going to get done until well after the inauguration. But this Defense Production Act theoretically gives the incoming administration a great deal of leeway to do something without Congress, and the COVID crisis also gives them a great deal of political cover. So that's something I'm watching, but it's tough to really put a whole lot of concrete framework around it at this point.